Hey, everybody. Thank you so much for tuning in. My name is Matthew. This is our 12th and final video wrapping up our intro money supply series on the United States dollar. We've done all the hard work. Now I'm going to show you a total breakdown of the United States dollar money supply. So let's get to it. We've done a lot of work so far. I encourage you, if this video is confusing to you, please take a look at the prior 11 videos on this intro to the US money supply series we've done thus far. We cover every single item that I'm about to talk about in detail in one of those videos. So let's take what we've learned and let's build out the entire money supply for the US dollar. This is going to be divided into two types of money, as you see in the title. We have state money, or sovereign money, or money that comes from the government. And we have bank money, or market money, or money that comes from banking institutions, but also, as we know, as we remember from the M3 money supply, also non-banking type institutions are involved, primarily in the M3, but definitely non-banks, shadow banks, they are involved as well. The first one we're going to show you, the big whale here, the bank reserve portion of the United States dollar. This is part of the monetary base. This is part of state money. This is the whale. As you can see, it's just exploded since 2008, global financial crisis. This is a new monetary epoch that we are in. It's never before been like it has. This is each bank's account with its central bank, i.e. the Federal Reserve in this case. Each bank's account with the Federal Reserve, in total known as the bank reserve portion of the Federal Reserve's balance sheet, the bank reserve portion of the monetary base. And as you might remember, non-banks have gotten into the scene of the Federal Reserve's balance sheet in the last few years as well. We're going to look at the Fed reverse repurchase facility right now, Fed Repos. I'm calling it still Fed Repos because as you count up money, remember you're always counting liabilities. This is a liability for the Federal Reserve. It's a repurchase agreement for the Federal Reserve. Who holds the reverse repurchase agreement? Primarily money market funds, primarily non-banking institutions connected with broker dealers, hedge funds, subsidiaries of banks, so on and so forth. When we start to get into M3 money, this is kind of a part of M3 money, but since the state has such an involvement, we have to keep it here in state money. It is absolutely state liquidity that is a part of the system now. Next up, traditional things should be understandable. We have vault cash. How much cash and coin is actually inside of bank vaults, not circulating around the economy inside of bank vaults. If you remember here from the demand deposit video, this is the smallest component of basically any money supply. There's no bank vault that can hold all of the vault cash if we want full reserve banking. It's never worked that way, even with gold and silver in the past. It just doesn't work that way. Vault cash is a minute portion of the state money supply or any money supply. I'm going to show it right now. You might not even be able to make it out, but it's a slightly lighter shade of blue coming right now. There it is. Let's go actually back in the past. Much bigger in the past, interestingly. You can see when the bank reserve portion was so small, vault cash was actually bigger than bank reserves. So when you would look at what would banks be able to lend against in the old days, they would lend against their reserve account at the Fed, their reserve account at the central bank, that's the darkest blue area, and they would lend against how much cash is in the vault. So in totality here, by the mid-'80s, you had $37 billion of base money in banks. That's what we have here. But then, of course, everything is just blown out of the water after the global financial crisis. Vault cash was a bigger portion. You see repos coming in here in the early 2000s, but vault cash lost any semblance of a meaningful portion of the monetary base from the global financial crisis, where now it's just an extremely small portion. Next up, we have the money supply that is confusing to some people, because if you're the Bank of England, so if you live in England, or the Reserve Bank of South Africa, if you live down there, they call the entire monetary base M0. But what it is in most countries, and what of course makes the most sense, as it's part of the inside money supplies, or it's inside the economy, inside the banking system, we have M0. M0 is a part of M1. M0, what is that? That is physical cash and coin that has been printed and is outside of bank vaults. So it's the remainder of physical currency that the Federal Reserve or any nation's central bank has printed outside of the banks. And here it is, M0. This is the lightest shade of the monetary base. And as you see here, for sure, the biggest portion leading up to the global financial crisis of 2008. And, you know, if we just look at the way that the Federal Reserve had been banking the economy before the global financial crisis, it actually didn't seem too crazy. There were certainly other things that were happening in the economy, other sources of liquidity sloshing around. The Federal Reserve absolutely had a key role to play, because they manipulate interest rates, which permeate and fluctuate all the way throughout the economy. We haven't talked about interest rates at all yet. We will. But you see that far and away, the vast majority of the monetary base pre-2008 was M0. That is physical cash and coin outside of bank vaults. $770 billion of the roughly $850 billion or so, a little bit more, close to $900 billion of base money just before the financial crisis. And physical cash has been growing as well post GFC, but not nearly as fast as bank reserves and lately the Federal Reserve repurchase agreement activity. And again, when you see repos, just think shadow banks. So this is state money. This is state money in its entirety over the last 60 years. Yes, I'm going to find and compile better data so we can see what's happening even further back in history. But the modern M's, as we've talked about, compiled by Paul Volcker and Fed economists here in the 50s and the 60s, this data only really starts in January 1959, the most consistent type of data. So here it is, over the last 60 years, state money. Now we're going to move into bank money. It's going to be delineated by the green shaded areas, the green shaded money supplies. And as I mentioned, M0 is one that straddles both. It is a part of M1, but of course now these things are stacked. You see here in the subtitle, stacked. And remember, all of these M supplies, these public-facing, narrow and broad economic money supplies, they're cumulative. So if you want to stack these things, you want to look at the various components, you have to remove the components that are lower than that. So now I'm going to show you the non-M0 portion of M1. And there we go. This is the darkest green area that you're going to see here, the non-M0 portion of M1. And what is the non-M0 portion of M1? The sight deposit. That's the traditional name for the checking account or the demand deposit. So again, M0 is included in M1 in the official calculation. M0 plus demand deposits equals M1. And we had to do a lot of work here because after the COVID stimulus and all of the reserve ratios are basically blown out of the water in the United States, not in all countries, but in the United States, there is no reserve ratio anymore, which again would have been that bank reserves plus vault cash, base money in banks, basically. We had to reconstruct M1 here using the limited data that the Federal Reserve has given us. But I have been able to do that, and I'm going to definitely keep doing that. Even if it's not completely accurate, you can definitely still see the trend with this reconstructed M1 money supply that I have created. And now we have M2. M2, remember, this is sometimes said as less liquid, but really it's just less regulated retail type monetary instruments. Savings deposits, small time deposits, retail money market funds. Here is M2. And again, I have to remove M1 to stack this and to show you the non-M1 portion of M2. Here it comes. Big one. We have savings accounts in here, as I said, small time deposits, retail money market funds. And again, not every nation, even though they follow the Federal Reserve's lead on this, and every nation does report these broader money supplies, these bank-facing money supplies now, not every nation will compile M2 or M3 the exact same way that the Federal Reserve does. So that's why to find the most liquid form of money, you always have to go as far out as you can. And unfortunately, the Federal Reserve has stopped publishing M3, as we talked about in February 2006. So I had to reconstruct an M3 money supply. But I have done so for you. It is coming up right now, the lightest shaded green, the most broad liquid form of money supply in the United States. It still exists. It's definitely still there, even though the Fed doesn't report it. And as we quoted former Fed economist from the Center for Financial Stability, William Barnett, this would be a trivial thing for the Federal Reserve to publish. They do not. So I'm doing it here for you best I can, reconstructing it. This is non-M2, M3. What is that? That is institutional, less regulated type monetary accounts and monetary instruments. Here is M3, the non-M2 portion. And there you go. That's it. That is the total money supply of the United States. The green shaded area is bank money, and in M3's case, non-banks as well. The blue shaded areas are state money, or the monetary base. And they don't count this repo section of the Fed's balance sheet as part of the monetary base yet. I have not done so either when I specifically refer to the monetary base, but you got to add up all the liquidity here. These are public-facing liabilities for banks and bank-facing liabilities for the central bank. That is what is included in all of this data. So this is total liquidity in the United States economy. One more item, of course, as always, to point out, this does have a Eurodollar estimate continuing on from what the Federal Reserve had in 2006 when they stopped publishing. Eurodollars are dollar-denominated deposits in banks and non-banks outside of the United States, outside of the Federal Reserve's jurisdiction. The Federal Reserve was even undercounting this amount. Before 2006, it's been written about, it's been talked about a lot. It's not even reported post-2006. So I have an estimate that grows basically as the same scale, the same rate that the rest of M3 grows. It's way underreported. I know that. We'll talk about Eurodollars in a second here. But let's just table that, and let's just recognize the fact that I guess I am a little bit proud of this because you're not going to find this data anywhere else at the moment, unfortunately. It would be trivial for the Federal Reserve to keep reporting data in a very transparent fashion. They have chosen not to do so. Again, plenty of former Federal Reserve economists have admitted as such. But this is the total liquidity for the United States dollar. Total money in the economy. State money in blue, bank money in green, total dollars sloshing around the United States economy and the global economy in some sense as well. So now let's compare the two. Let's see the evolution of state money versus bank money. And for that, I'm going to draw just one line on the right axis. This video, the dotted black line, is going to show you the proportion of state money to total money. And there it is. And actually, let's go ahead and put the last indicator on the chart as well. This is going to be a red line. This is the total money supply, just so you can see it in the tooltip. It is what you see here in green, but again, this is stacked, so you just see the components. Now I'm going to show you the total money supply in red. There we go. So, knowing the total money supply, seeing this black proportion, you'll be able to see percentage-wise how much the blue is compared to the total number. So if we go back to the very beginning, again, this is a pseudo gold standard, gold exchange standard, pre-Nixon shock here in the end of the 50s, 60s, and 70s, start of the 70s here. State money, the monetary base, it started out a little bit high, actually, 13%. And by the start of the 70s, it was under 10, under 9%, even 8.6%. Let's just zoom out. Let's keep going down. Nothing fancy here, all the way to the global financial crisis. Start of the 70s. So now, again, we're on a purely fiat monetary standard. No gold has any statutory link to the dollar, even though the United States continues to hold it and other central banks around the world continue to hold it. No statutory link for the dollar to gold. Down, down, down. You see bank money and non-bank money as part of M3 is growing. A little bit of a reversal here in the 90s. This is kind of interesting too, because this is actually just about the time that Robert Rubin, Secretary of the Treasury, came in under Clinton. And you remember the narrative pre-global financial crisis is that the banking system was completely deregulated at this point. Actually, state money rose as a proportion of bank money, and you actually see bank money was stagnating here a little bit. Interestingly, this was also the birth of the World Wide Web, 1995, .com boom, .com bust. Alan Greenspan, the maestro, as the New York Times called him, governor of the Federal Reserve, took interest rates to historical lows at that time. State money as a proportion of bank money, however, continues to fall to just the eve of the global financial crisis. The peak would be somewhere here, I guess. March 2008. Total money supply, $17.3 trillion. The state money component, quite small, 5.2%. Now, I happen to think that's a very good thing. Actually, I happen to think that's a very good thing. Though I have to hasten to say, again, interest rates permeate throughout the economy. The Federal Reserve is still in control of interest rates, which they do manipulate on the margin with bank reserves and the rest of the monetary base. And as I mentioned, we will get to interest rates. Plenty of time to analyze interest rates on this channel. Interest rates were going to historical lows all through here after 9/11 and after the .com bust. So that could explain why so much creation of credit, the housing bubble, collateralization, mortgage-backed securities, so on and so forth, took off. That could have something to do with it. But the monetary base had not actually exploded at all at this point. This shows you the power that the Fed had at the time, because interest rates, again, they're done on the margin, and they permeate all the way through the economy. And the Federal Reserve was able to do that without changing the monetary base in a big way at all. You see here, interestingly, bank money sort of stagnates. This is, Bear Stearns had happened just a little bit before here in 2007. And perhaps at this point, it was where most of the banks and the non-banks realized that this was a house of cards based on cheap credit and low interest rates, and things needed to cool off and stop. And this was precisely at the time that interest rates were now rising. So all these variable rates were getting reset, so on and so forth. I imagine many of you watching this understand that story. And then we have the global financial crisis. And from there, it's a completely new ballgame. Doesn't actually seem as extreme when you zoom in here compared to here. But you can see that the makeup of state money versus total money, of the monetary base versus total money, is completely different. The game has completely changed here post 2008. So we get all the way to, should have been 2014. Let's see what the percentage is. 19.5% state money, and then actually a little bit higher in September 2015. That's probably due to repos coming in. Yes, there's a little bit of bump in repos. We can see here a little bump in late 2015, but really from mid 2014 into 2015 and on, all the way until nearly before COVID, the money printing was done. A fact that is always misconstrued by gold bugs or even Bitcoin bugs, people that don't look at the data. QE1, QE2, QE3. It was already done here by mid 2014. I'm not defending it at all. I'm not defending the policies of the Federal Reserve or the central bank, but people that just like to pontificate about the philosophy of money and there's too much money printing or there's not enough money printing or money is just something we all agree on, they're not actually looking at the facts. They're not actually looking at the data. This is what happened. So there was not a continuation of money printing. And when I say money printing, that is base money. That is the blue shaded area here. That is state money coming from the core of the system. It went down. It went down. You see down, down, down until there's actually a big hiccup in the repo market here in September of 2019. Still went down though. And then compared to what happened here with COVID, we see the money printing, the stimulus, the bailouts, all of that just, as we know, increased rapidly from the beginning of the COVID pandemic to where we are again. If you look at the percentage, back up as a percentage of total money as of just a couple months ago, 21.5% total state money as a percentage of total money in the United States. Pulling this back here, we can see that we were over 10% again, fell all the way to nearly 5%, and then now we're as high as we've ever been, 21.5%. A few points to say about this now. This is unfortunately a hybrid market. Okay, this is not a free market. Even though more of the market is represented here in green than is represented in blue. There's no market activity in blue. Even the green market activity, as we know, from the darkest, the demand deposits, all the way to the lightest, repurchase agreements, Eurodollars, money market funds, so on and so forth. It is just a massively regulated industry. Money, banking, it's massively, massively regulated. And when a financial crisis occurs, they blame it on the lack of regulation and they bring in even more regulation. And this is just very unfortunate because we can see that if the central bank was supposed to be so prescient and so omniscient, then they wouldn't have allowed the global financial crisis to happen. And this might take some study again of interest rates to see how much interest rates permeate the economy on the margin, why all of these cheap real estate loans were a problem leading up to the global financial crisis, so on and so forth. But we can just see that, you know, if you studied cyclical businesses, you know, even in an inflating fiat dollar, but if you studied businesses that, you know, tourism that boomed in the summer, maybe a little bit of a lull in the winter, you would just see hard work and you would see revenues flowing in the summer and not as much in the winter. And you would just see economic flows. When it comes to money, remember, we had seasonality on M0. Let's actually see if we can show it really quick. Let's take everything off here, but M0. You can see it a little bit here before the GFC again. More physical cash printing. The rate of money printing increased after the global financial crisis. Was not that high before. But you see there's little bumps here at the end of every year. Okay, and this goes way back to ancient times even. All right, when the harvest was occurring, when the work was being done before the winter, that's when people demanded payment. That's when cash balances needed to be the highest. So that continues even to this day. So that is something that kind of looks, let's put everything back on. That looks seasonal. That looks normal. That looks like the market is reacting to work that is being done and, profits and wages that need to be paid. But if you look at this in total, we just see that, any semblance of cyclicality or patterns, it's just gone. It's completely gone when we look at the total money supply. And the biggest lumpiness, the biggest problem that we can see is involvement from the central bank. And then you might ask the question, well, why? Well, the presumption is that they bring stability to the economy. But as I've said, things tend to get more volatile when they're involved. And you just have to ask the simple question, why couldn't they stop crises in the first place? All right, the central bank was set up in the United States in the early 20th century to supposedly stop small change crises in the 19th century. The same goes for many other central banks around the world. But as I showed you with the quote from Dr. Seljan yesterday, the vast majority, let's just read it again for this video. It's overwhelmingly clear that the least regulated banking systems of the past, including ones without central banks particularly, performed very well as far as the frequency of crises. So we have to come at this with a philosophy, with a principle, with a theory. And as the economy continues to evolve, but we see this non-predictable, non-cyclical, tenuous sort of a nature occurring with the money supply, we may need to ask, what is causing that? Is it the market or is it the state? My contention, the contention I think of anybody who loves freedom and property and taking care of each other and serving each other in the market, is of course it's going to be the state. And this theory is underpinned and it comes about by one core assumption. And what is that? Well, a monopolistic actor in the market will never know what the true market clearing price is based on supply and based on demand. And make no mistake about it, this blue portion of the United States money supply is the central bank of the United States. It is a monopolistic actor. So we need more freedom. We need more banks interacting in the market freely by their own volition, taking deposits, making loans freely, able to fail, by the way, freely. Imagine where we would have been here if we had just had let all the bad actors fail in the global financial crisis instead of intervening. As Ben Bernanke said, the Federal Reserve caused or exacerbated the Great Depression. He told Milton Friedman that. His assumption, of course, was that the Federal Reserve didn't intervene enough, so he wasn't going to make that same mistake. Indeed, he didn't. But the policies that have continued from there, the non-predictable, non-cyclical nature of the money supply, it does seem a bit tenuous. But make no mistake, the reason that there's this tension in the economy is not because of the market itself. It's not because of fractional reserve banking. It's not because of free banking. It's because there's a monopolistic issuer in the society, and that is the central bank. So thank you for listening to that little soapbox here. Try not to do that too much, actually. Try to just show you the how and the what rather than talk about the why. But of course, the underpinning of my education and my philosophy is that free markets are going to work. Corporatism, corrupt, crony capitalism, monopolistic dominance by a state actor won't work. And so we always have to be wary of that. I mean, why don't we just have one central bank controlling all the money in the entire world? Right? As Keynes said, the bankor. Or we could have free market money that can't be controlled by any one bank, any one government, any one individual. We had that for thousands of years, gold and silver. But as we've seen, and as I've talked about many, many times, central banks around the world, they actually have monopolized a lot of gold. And Alan Greenspan has said as much, that we stand by ready to sell gold should the price rise, because the rising price of gold is a rebuking of central bank policies. So central banks around the world hold about 1.1 billion ounces of the 6.4 billion ounces of gold that have been mined throughout humanity. But we do have one other interesting free market money that is not controlled at all by the state. It's digital, possibly base money of the future, and that is Bitcoin. So we're definitely going to study a lot about Bitcoin and how that could interact with the money supply in the future. Just to talk about the difference again between state and bank money, or state and market money. Again, market money in green, state money in blue. From the perspective of how Bitcoin could interact with the economy, again, this is only the dollar. This is only the United States, which is 1/4 of the world's economy. So if you just want to do a rough estimation, $37.4 trillion times 4, $150 trillion worth of money globally. People like to look at that red line and say that's the number that's going to compare with the Bitcoin market cap, the Bitcoin valuation. And you just need to understand that economically, Bitcoin has nothing to do with the shaded green areas. All right. As far as we know, credit and banking can continue under a Bitcoin standard. And if it does continue under a Bitcoin standard, then Bitcoin will have Satoshis, Bitcoins, represented as claims as part of a fiduciary institution's balance sheet, claims trading around, which have nothing to do with the UTXO of Bitcoin. This is the same way that it works now in our fiduciary dollar-based system now. And by the way, this is also the same way that crypto exchanges work now. You have this fiduciary relationship. When you deposit Bitcoin on an exchange's balance sheet into an exchange, you do not own that Bitcoin anymore. You don't own nothing, but you own a claim. You own a Satoshi denominated, a BTC denominated claim that you can at any time go back to the bank and withdraw your Bitcoin. It's the same exact way here for the dollar fiduciary system. Yes, Bitcoin is limited, predictable, secure, very different, decentralized than the United States system, which is centralized here in this blue shaded area around the Federal Reserve and its 12 district banks around the United States. It is a highly, highly concentrated system, the United States dollar. But if you want to know economically what money supplied here compares with Bitcoins, with on-chain UTXOs, with Satoshis, it's not the green shaded area. All right, the green shaded area is a Coinbase account, a Kraken account, Bitfinex account. Bitcoins, on-chain UTXOs, bearer instruments on the protocol that you can exchange with one individual or another if you own the private keys to that UTXO. That's represented in the blue. That's represented in the blue. Again, I know the central bank functions in a different way than the Bitcoin protocol functions. I understand that. But economically, a bearer UTXO Bitcoin is only comparable with the blue state money here. It's not comparable economically with bank money, the green shaded area. There are things to say about Lightning, which is definitely a new type of payment, which I will do in the future. But for now, the way that we talk about trading claims, making payments in the current fiduciary banking system, the green shaded area does not at all compare to a Satoshi, an on-chain UTXO. So keep that in mind. And of course, as well, this doesn't compare to what Bitcoin can do globally because this is only the United States. And on that note, I guess there's just one final point that I have to make. We have to talk quickly about the Eurodollar. The Eurodollar is also an X factor in the liquidity of United States money. It is a deposit, as we know, outside of the jurisdiction of the Federal Reserve. So stable coins, by the way, are Eurodollars, and they are inside of this money supply. I've talked about that. See my M3 video for more on that. But my Eurodollar estimate is no doubt, which is inside of M3, it is no doubt understated. I don't dispute that. No one knows the total value of Eurodollars. See my estimates and my benchmarks, Panama Papers, Paradise Papers, Pandora Papers in the Eurodollar video for more there. I don't dispute that. But I wonder what we can say about this proportion of the state component of money versus total money if we knew the value of Eurodollars. Certainly it's more, but how much more? I have a few figures just to show you, just to kind of think about this in an interesting way. So I'll just leave the tooltip up. You can see the total money supply there, $37.4 trillion at the moment, at the end of December. And the ratio is 21.5%. And the total state money, which you don't see there, but add up everything in blue, it's about $8 trillion exactly. So if we fall to a state component ratio of 20%, that would mean $40 trillion in total money, i.e. what's the excess, what's the difference between what I've recorded and the total? $7 trillion. So that would mean $7 trillion more dollars to fill the gap for Eurodollars at a 20% ratio of state to total money. If this ratio fell to, say, 10%, which is kind of a historical ratio before the 80s, if it fell to 10% state money to total money, you would get 80 trillion, because we have 8 trillion in base money and state money. That's a 43 trillion Eurodollar market, because we have 37 recorded here officially. So maybe the Eurodollar market is $43 trillion. Or if we wanted to fall back to the ratio here of 5% state money to total money pre-global financial crisis, that would mean $160 trillion total money market. Subtract what we know, which is $37.4 trillion. And again, basically Eurodollars are not included. There's just a small component in my money supply. So the gap there would be $123 trillion worth of Eurodollars. Now, I'm going to work very hard, as I've mentioned before, to calculate Eurodollars, looking at every central bank's balance sheet and a bank survey. But this is a very difficult thing, but it's just interesting to see that if we knew the amount of Eurodollars, and absolutely they're higher, that they make the total money supply higher than what you see. So if we knew the total amount of Eurodollars in M3, this dotted black line would be lower. How much lower? I've just shown you some interesting ratios. If it goes down to 5%, then you have $123 trillion of Eurodollars sloshing around the world. I don't think it's probably that low. Maybe the 10% ratio. We go back to somewhere around here. Yeah, even 60s levels, basically, pre-1970 levels. We go back to a 10% ratio. That would imply Eurodollars that are roughly 40 to 45 trillion dollars worth. That's the question that we need to sort of come to grips with next. This is pretty good, pretty well-constructed money supply for certainly dollars that are inside the United States and a little bit outside, because we're counting repos best we can based on new data that the Federal Reserve published since 2012. We're counting some Eurodollars. We're counting all institutional time deposits, money market funds, so on and so forth. We got this huge Fed repurchase facility down there, denoted by the little factory icon, which is now outside of the whale base money bank reserve account. You know, we're entering non-bank territory, shadow bank territory there. So we got all these different money supplies included in our 37.4 trillion massive pool of liquidity for the United States dollar. But there is this big X factor with the United States, this big question mark, which is Eurodollars and the amount of Eurodollars that are circulating. So that's going to be a long-term project for me to try to determine a better estimate of how many Eurodollars are sloshing around the world. Remember, Bitcoin economically compares with the blue shaded area, and regardless of Eurodollars, what we have seen so far since the global financial crisis is a massive increase of state money to total money in the economy. Hope you enjoyed that. Thank you, those of you who tuned into this intro series on the money supply. Hopefully you can refer to this anytime you have any questions. Let me know in the comments if you'd like to see anything else as it relates to this money supply. Appreciate it. Take care.